In the name of Jesus, thy we shall be Allah.
Hello, ladies and gentlemen. Today, I will be reading a book for you. A book about Warren Buffett. We'll be looking at S&P 500 chart in real time. And I'll be narrating. I will be reading a book for you. The Tao of Warren Buffett. How to stay rich. Number 1. Rule number 1, never lose money. Rule number 2, never forget rule number 1. The great secret to getting rich is getting your money to compound for you. And the larger sum you start with, all the better. As an example, $100,000 compounding at 15% for 20 years will grow to $1,636,653 in year 20, which gives you a profit of $1,536,653. But let's say you lost $90,000 of your initial capital before you even started and could only invest $10,000. Your investment would then only grow to $163,665 in year 20 for a profit of $153,665. This is a much smaller number. The larger the amount of money you lose, the greater the impact on your ability to earn money in the future. That is something that Lion has never forgotten. It is also the reason why he drove an old VW Beetle long after he was a multi-millionaire. Number 2. I made my first investment at age 11. I was wasting my life up until then. It is good to find one's calling early in life, and in the field of investing, it allows for unparalleled opportunities for the magic of compounding sums of money to work. The time to gamble is not when one is young, when there is so much time ahead to profit from wise decisions. The stock that Warren bought when he was 11 was in an oil company called City Services. He bought 3 shares at $38, only to watch it sink to $27. He sweated it out, and after it recovered, sold it at $40 a share. Shortly thereafter, it soared to $200 a share, and he learned his first lesson in investment: patience. Good things do come to those who wait, provided you pick the right stock. Number 3. Never be afraid to ask for too much when selling, or offer too little when buying. Warren understands that people fear embarrassment if they ask too high a price when selling, or offer too low a price when buying. Nobody wants to be seen as greedy or cheap. Simply stated, in the world of business, how much money you get from a sale or how much you have to pay when making a purchase determines whether you make or lose money and how rich you ultimately become. Once negotiations begin, you can come down on your selling price or up in your buying price, but it's impossible to do the opposite. Warren has walked from many a deal because it failed to meet his price criteria. Perhaps the most famous example was the Capital Cities purchase of ABC. Warren wanted a larger share of the company for his money than Capital Cities was willing to part with, so he walked from the deal. And the next day, Capital Cities caved in and gave him the deal he wanted. Ask and you might just receive, but if you don't ask... Number 4. You can't make a good deal with a bad person. A bad person is a bad person, and a bad person will never make you a good deal. The world is filled with enough good and honest people to doing business with the dishonest ones is sheer foolishness. If you even have to ask yourself a question, do I trust this person? You should immediately leave the negotiating table and look for your honest company with them to do business. You don't want to doubt that your parachute will open when you are about to jump out of a plane, and you don't want to doubt the integrity of the person with whom you are about to jump into business. If you can't trust them now, you won't be able to trust them later, so why trust them at all? Warren had this lesson to know when he was sitting on the board of directors of Salomon Brothers. Against Warren's advice, Salomon's investment bankers continued to do business with media mogul Robert Maxwell, whose finances were so precarious that his nickname was the Bouncing Check. After Maxwell's untimely demise, Salomon found itself in a big mess trying to recover its money. The rule is simple: people with integrity are predisposed to perform. People without integrity are predisposed not to perform. It is best not to get the two confused. Number 5. The great personal fortunes in this country weren't built on a portfolio of 50 companies. They were built by someone who identified one wonderful business. If you do a survey of the super-rich families in America, you will find that almost without exception, their fortunes were built on one exceptional business. The Hearst family made their money in publishing, the Walton family in retailing, the Wrigley family in chewing gum, the Mars family in candy, the Gates family in software, and the Coors and Bush families in Berlin. The list goes on and on, and almost without exception. Anytime they strayed from that wonderful business that made them so amazingly rich, they ended up losing money, as when Coca-Cola got into the movie business. The key to Warren's success is that he has been able to identify exactly what the economic characteristics of a wonderful business are. A business that has a durable competitive advantage that owns a piece of the consumer's mind. When you think of gum, you think of Wrigley. When you think of a discount store, you think of Walmart. And when you think of the cold beer, you think of Coors or Budweiser. This elevated position creates their economic power. Warren has learned that sometimes the short-sighted nature of the stock market grossly undervalues these wonderful businesses. And when it does, he steps up to the plate and buys as many shares as he can. Warren's company, Berkshire Hathaway, is a collection of some of the finest businesses in America, all of which are super profitable and were bought when Wall Street was ignoring them. Number 6. It is impossible to unsign a contract, so do all your thinking before you sign. Warren has learned that once you sign, the deal is done. You can't go back and rethink whether it was a good deal or a bad one. So do all your thinking before you sign. This is easier said than done, but once that paper is shoved under your nose, sound reasoning often flies out the window in the name of getting the deal done. Before signing a contract, imagine all the things that could go wrong, because they often do go wrong. The road of good intentions is paved with what are foreseeable troubles. Thinking long and hard before you take the leap will save you from having to think long and hard about all the trouble you just signed on for. Warren forgot to put a non-compete clause in his contract with 89-year-old Rose Blunkin when he bought her Omaha-based Nebraska furniture mart. A few years later, Mrs. B got angry at the way things were being done at the store, so she quit and started up a new store across the street, stealing tons of business from NFL. After a few years of suffering with stiff competition, Warren caved in and agreed to buy her new store for a cool $5 million. The second time on the outer signed a non-compete agreement, and it is lucky for him that he did, so she continued on in the business until she was 103. Number 7. It is easier to stay out of trouble than it is to get out of trouble. It is far easier to avoid the temptation of breaking the law to make easy money than it is to deal with the consequences if you get caught. To stay out of trouble, just do the right thing at the right time. To get out of trouble, you need a lot of money and a lot of legal talent, and even then you may end up serving a lot of time. This lesson was driven on when Warren nearly lost his entire $700 million investment in the Wall Street arm of Salomon Brothers. The Federal Reserve Bank came within inches of shutting down the entire firm for its illegal bond trading activities, which were committed by a trader trying to make a quick buck. What did it cost to get out of trouble? The jobs of several of the firm's top traders, the jobs of its chairman and CEO, and millions in legal fees, fines, lawsuits, and lost business. It would have been a lot easier and far more profitable to have stayed out of trouble from the start. Number 8. You should invest like a Catholic marries for life. God knows that if you view an investment decision from the perspective that you will never be able to undo it, you will be certain to do your own work before taking the plunge. You wouldn't jump into a marriage without doing your research, digging, and discussing it with your advisors, your pal with the pub, and thinking long and hard about it, would you? Nor should you jump into an investment without knowing a lot about the company and making sure you understand it. But it is the life part that really makes the money. Consider this. In 1973, Warren invested $11 million in a Washington Post company, and he remains married to this investment even to this day. And over the 33 years he has held onto it, it is going to be worth $1.5 billion. The conviction to stay the course can bring heavenly rewards, as long as you have chosen the right one to begin with. Number 9. Wall Street is the only place that people ride to in Rolls-Royce to get advice from those who take the subway. Warren has always thought it strange that highly successful and intelligent business people who have spent lifetimes making huge sums of money will take investment advice from stockbrokers too poor to take their own advice. And if their advice is so great, why aren't they all rich? Maybe it's because they don't get rich off their advice, but off charging you commissions. One should beware of people who need to use your money to make you rich, especially when the more things they sell you means the more money they can make. More often than not, their agenda is to use your money to make themselves rich. And if they really your money, well, we just go out and find someone else to sell their advice to. Warren feels so strongly about where Wall Street's true loyalties lie that he refuses to even look at the business projections that its analysts put together, because regardless of the nature of the business, the projections are always way too rosy. Number 10. Happiness does not die in money. Warren never confused being rich with happiness. We're talking about a guy who still hangs out with the same people he did in high school, and still lives in the same neighborhood in which he grew up. Money hasn't changed who he is on a fundamental level. When asked by college students to define success, he has said it is being loved by the people you help love you. You can be the richest man in the world, but without the love of family and friends, you would also be the poorest. Number 11. It takes 20 years to build a reputation, and 5 minutes to lose it. If you think about that, you will do things differently. One foolish act and a bad press that goes with it can instantly destroy a good reputation that has taken a lifetime to build. It's best not to do something that you know is wrong, because if you are caught, the price you pay may be more than you can afford. This is a Buffett credo that he whispered into the ears of his children from the time they were tots. When the accounting scandal came down with insurance giant AIG, Buffett told his narrators, "The current investigation of the insurance industry underscores the imperative of the message that I regularly send to you in my biannual memo. Berkshire can afford to lose money, even lots of money. It can't afford to lose reputation, even a shred of reputation. And in the long run, we will have whatever reputation we deserve. There is plenty of money to be made in the center of the court. There is no need to play around the edges." Wall Street is littered with fallen giants who let greed get in the way of good judgment and failed to heed this advice. Number 12. The market, like the Lord, helps those who help themselves. But unlike the Lord, the market does not forgive those who know not what they do. The stock market is there to make you rich if you know what you're doing. But if you don't know what you're doing, it will show no mercy in making you poor. Ignorance, when mixed with greed, is the stuff financial disasters are made of. In 1969, at the high end of the 60s bull market, Warren bought stock for so overpriced that he got out of the market completely. By 1973 to 74, the stock market had completely reversed itself. Stocks were selling at bargain prices. Warren bucked them up with the appetite of, as he said, a sex-starved man in the middle of a town filled with beautiful women. Many of those beauties went on to help make him a billionaire. As for those investors who stayed in the market after Warren left in 1969, many of them lost their shirts when it crashed in 73-74, and getting back in became impossible. You need money to buy stocks. It really does help if you know what you are doing. Number 13. I don't try to jump over 7-foot bars. I look around for 1-foot bars that I can step over. Warren isn't shooting for the stars. He isn't trying to hit home runs on every pitch. He is waiting for the perfect pitch and is staying with the sure thing. Companies with products that don't have to change. Businesses that he knows will still be around in 20 years, selling now at a price that makes business sense, even if he were buying the whole company. Lucky for him that the short-term focus of the stock market often neglects the long-term economics of the business, which means the stock market will often misprice a great business. It keeps it simple and leaves all the fortune-telling and complex investment strategies to the other guys on Wall Street. In the stock market crash in 1973 to 74, you could buy Ogilvy and Mather, one of the strongest advertising agencies in the world, for $4 a share against per-share earnings of 76 cents, which equated to a PE of 5. Warren bought a ton of it during the crash and cashed out many years later after an annual rate of return of better than 20%. Some investments are just that simple. Number 14. The chains of habit are too light to be felt until they are too heavy to be broken. This is why I'm quoting the English philosopher Bertrand Russell, because his words so aptly describe the insidious nature of bad business habits that don't become apparent until it is too late. Such as cost-cutting after your business is in trouble, which should have been done long before you even got to the doorsteps of danger. The business that becomes bloated with unnecessary expenses in times of plenty is the business that will sink when things turn for the worst. This propensity to belittle himself also tells you a lot about the management that let the business become bloated with expenses in the first place. It is best to consciously check where all your habits are taking you long before you get there. If you don't like the direction in which you are headed, the time to change course is before you find your ship sinking in a sea of troubles. This is what happened to Warren with the Benjamin Graham-inspired investment strategy of buying bargain stock that was selling below book value regardless of the nature of the company's long-term economics. This was something Warren was able to do with great success during the 1950s and early 1960s. But he stayed with this approach long after it wasn't viable anymore. The chains of habit were too light to be felt. When he finally woke up in the late 1970s to the fact that the Graham bargain line was over, he shifted over to a strategy of buying exceptional businesses at reasonable prices and then holding them for long periods, thereby letting the business grow in value. With the old strategy, he made millions, but with the new one, he made billions. Number 15. Marrying for money is probably a bad idea under any circumstances, but it is absolutely nuts if you are already rich. The wise know that if you marry for money, you will earn every penny of it. So if you are already rich, why on earth would you want to work that hard? It is easy to marry for love and make the money later. It is what Wine did with his wife Susie. They found love, and the new one out and made a fortune. Besides, the couple that makes money together is often the couple that stays together, and if they don't stay together, at least they have a ton of money to fight over. Warren is silent on the wisdom of divorce. Number 16. It is not necessary to do extraordinary things to get extraordinary results. As an investor, you don't have to try to get rich overnight to eventually get rich. Warren is shooting for a 20% annual rate of return, not a 200% annual rate of return. Invest $100,000 for 20 years, at 20% a year, and you end up with $3.8 million. Hold it for 30 years and you end up with $23.7 million. You win with the running game, not the long bomb. With the world trying to get an annual return of 100%, a lot of mistakes are being made regarding long-term business economics that make getting a 20% annual return pretty easy. Number 17. You should look at stocks as small pieces of a business. Sometimes when people invest, they forget that they are actually buying a fractional interest in a business. One wants to look at stocks as owning a small piece of the business. This way he can judge whether he is paying too much for the business. He multiplies the stock price by the number of shares outstanding and asks himself whether this would be a good deal or a bad deal if he were buying the whole business. If the price is too rich to be buying the whole business, then it is too rich to be buying even a single share. This thought alone can stop you from foolishly getting caught in the speculative frenzy that often goes with a bull market. For seldom do Wall Street darlings and other fashionable securities sell the prices at which it would make sense to buy the whole business. Number 18. My idea of a good decision is to look in the mirror. Warren is not one to seek affirmation of his ideas from others, because so many of his ideas are the opposite of what the herd is thinking. To make big money in the investment world, you have to learn to think independently. To think independently, you need to be comfortable standing alone. Warren has a history of standing alone that dates back to the early days of his investment career. He chose to live in Omaha instead of New York City because there was less influence from Wall Street. He bought into Berkshire Hathaway when no one wanted it. He bought into American Express when no one wanted it. He bought into the Washington Post Company when no one wanted it. He bought into General Foods when no one wanted it. He bought into RJR Tobacco when no one wanted it. He bought into Geico when no one wanted it. He bought the bonds of the Washington Public Power Supply System when no one wanted them. And he bought into junk bonds when no one wanted them. Some of these investments he still owns. Some of them he sold after holding them a number of years. But on each and every one of them he made a fortune. If he had taken a vote of confidence from anyone on Wall Street, he would have missed the boat on all these great investments. Number 19. If I can't make money in a $5 trillion U.S. market, it may be a little bit of wishful thinking to think that all I have to do is get a few thousand miles offshore and I'll start selling my stuff. The odd thing about this quote is that 10 years later, Warren did go offshore to sell his stuff. In 2003, he bought around $500 million worth of PetroChina, an oil company that is 90% owned by the Chinese government, which means, as Warren jokingly remarked, between the two of us, we control the company. PetroChina is the fourth most profitable oil company in the world. It produces as much crude as Exxon, and Warren bought it at 1/3 the valuation of Western oil companies. In case you were wondering, it is up 400% since then. And if that's not showing your stuff, I don't know what is. Number 20. You should invest in a business that even a fool can run, because someday a fool will. There are businesses with great underlying economics, and businesses with poor underlying economics. You want to invest in companies with great underlying economics because it is hard to damage these kinds of businesses. Companies in which Warren has invested, such as Coca-Cola, Budweiser, Walmart, Wrigley's, Hershey, and H&R Block, are almost dumb-proof. You know you're going to make money with these businesses, even if a fool becomes CEO. If you have to worry about a fool running a business, then maybe it isn't such a great business, and maybe you shouldn't be in it. Number 21. With each investment you make, you should have the courage and the conviction to place at least 10% of your net worth in that stock. Conviction is based on what you know will happen. Faith is based on what you hope will happen. To make money in the investment game, you need to have conviction, which means that you need to know what you are doing. A surefire way to achieve Warren's level of conviction is to invest significant amounts of money. This causes you to focus and make certain that you have done your homework before you make your investment. But if your investment strategy is based on faith, then you really aren't a prayer. Number 22. Money, to some extent, sometimes lets you be in more interesting environments, but it can't change how many people love you or how healthy you are. The truth is that excessively large amounts of money can actually create a great deal of misery in your life. Your children won't work because they think they're going to inherit a fortune, which means that they never develop any of the self-esteem that work create, which means that they end up being bitter and spending their time wishing you an early demise. If you are insanely rich, you may end up being surrounded by a bunch of sycophants who will fill your life with lies to stoke your illusions of grandeur till you look like a fool to the rest of the world. And instead of doing adventurous things with your money and life, you end up spending all your time guarding your wealth from your servants, lawyers, accountants, and so-called money managers, all of whom will assist you in making your money theirs. Warren believes that children who inherit great wealth tend to do nothing with their lives, nor does he believe that it is good for society if there is an upper class created by inherited wealth. He believes that a country prospers better if society is a meritocracy, with people earning what they get. For this reason, he donated the $32 billion fortune he made from investing to charity, so that it would go back to help the very society that created it. Let this noble thought find a place in the hearts of all who make their fortunes in the world. Business. Number 23. Anything that can't go on forever will end. A stock price that is quickly rising will stop rising when the economic reality of the business finally sets in. It might seem as if it can go on forever, but if a business fails to perform up to the expectations that are driving the rising price, the company's shares will peak and then drop like a brick. Most businesses that are doing well now will at some future point do poorly. Things change. It is only a matter of time. Buggy whips were at one time a great business in America. Video players were once the rage. Selling and fixing typewriters, a necessary and intricate part of the commercial equation. Now they are just things of the past, with no economic promise whatsoever. Things do end, which is why you not only have to keep your eye on the ball, but also on the road ahead. Several times Warren has invested in businesses that either came to an end or saw a radical decline under his stewardship. The most notable were Blue Chip Stamps, which all but vanished, and World Book Encyclopedia, which is now vanishing, each of which lost out to a changing business environment that the company was powerless to make money in. Even a genius can misread the road ahead. Number 24. When management with a reputation for brilliance tackles a business with a reputation for poor fundamental economics, it is the reputation of the business that remains intact. There are great businesses with great underlying economics that have the financial wherewithal to turn themselves around when they get into trouble. And there are mediocre businesses with poor underlying economics that are impossible to save regardless of the brilliance of amateurs. A great business is usually awash in cash, carries little or no debt, and is in a great position to either buy its way out of trouble or ride out any downturn in the economy. Mediocre businesses are always struggling for cash and are loaded with debt, and if they get into problems, they usually have to rob Peter to pay Paul, which leads to even more problems. No matter how brilliantly a mediocre business is run, its poor inherent economics will keep it forever anchored to poor results. Number 25. Accounting is the language of business. There are many ways to describe what is going on in the business, but whatever is said, it always comes back to the language of accounting. When Warren was asked by the daughter of one of his business associates what courses he should study in college, he replied, accounting. It is the language of business. To read a company's financial statement, you need to know how to read the numbers. To do that, you need to learn accounting. If you can't read the scorecard, you can't keep score, which means that you can't tell the winners from the losers. Number 26. Times seldom turn. The world is full of businesses with poor economics selling at what seem to be bargain prices. Warren looks for a good business that is selling at a fair price, or even better, a great business at a bargain price, which is hard to find. Poor businesses remain poor businesses regardless of the price you pay for them. The price of the stock may change, but the underlying character of a business tends to remain the same. If it is a good business, it will remain a good business. And if it is a bad business, it will remain a bad business. Bad businesses can't be turned into great businesses. Only in fairy tales do frogs turn into princes. And although many CEOs believe that they have the power of the magic kiss, 95% of the frogs they kiss remain frogs. And the 5% that do turn around probably weren't frogs to begin with. Warren believes that the same managerial energy and capital would be better spent buying a business with good economics that is selling at a fair price than on taking on a poor business in need of a magic kiss, even if it is selling at a bargain price. After kissing a few frogs in his life, he concluded that they don't taste very good. Number 27. If a business does well, the stock eventually follows. A market phenomenon that Warren relies on is that if the underlying business does well over a long period of time, the stock price will increase to reflect the underlying increase in the value of the company. Likewise, if the underlying business does not do well over a long period of time, the stock price will decrease to better reflect the underlying value of the company. The long-term value of the company has a way of rectifying the situation no matter which direction. Thus, internet stocks that saw their prices soar skywards during the bull market saw them drop like a rock when they failed to make any money over the long run. Likewise, great companies that saw their stock prices plummet in the stock market crash saw them immediately recover once the market saw that their earning power had remained intact. If you buy a stock that has had its price beaten down, you'd better make sure that the long-term economics of the business are still good. If they are, and the business does well over the long term, well, the stock. For the stock price to improve, the business must do well, and to do well, it helps immensely if it was a great business to begin with. The Washington Post Company, Coca-Cola, Disney, American Express, GMO Foods, Wells Fargo, Interpublic Group, and Geico were all companies that had excellent economics working in their favor at the time that Warren bought into them. But then stock prices that were suffering from either a one-time solvable problem, or an industry recession, or a bear market. With every single one of these companies, the long-term economics they possessed eventually caused the stock market to revalue their stock prices handsomely upward. Number 28. Managing your career is like investing. The degree of difficulty does not count, so you can save yourself money and pain by getting on the right train. One not only needs to learn what kind of business to invest in, but what kind to work in. If one goes to work for a company with poor long-term economics, then he can never expect to do really well because the company doesn't do well. Salaries will be below average, and raises will be few and long between. And there is greater risk of losing your job because management will always be under pressure to cut costs. But if you go to work for a company that has great long-term economics working in its favor, then the company will be awash in cash. This means higher salaries and tons of raises and promotions for a job well done. Plus, there will be plenty of room for advancement as management looks for ways to spend all that free cash. You want to work for a company that has high margins and makes lots of money, and you want to stay away from businesses that have low margins and lose money. One is a first-class train ride to Easy Street, the other is a long, slow, large freight train ride to a Siberian nowhere. Number 29. The reaction of weak management to weak operations is often weak accounting. If the business has lousy economics working against it, and the management lacks integrity, it will support weak accounting, which manifests itself by creating earnings where there really aren't any. This is very, very easy to do. Just book a cost as an investment in a partnership, then have the partnership pay you a fee out of the money you invested in it, which you book as income. Reduce costs and increase income with just a few strokes of a pen. The increase in earnings will get the shareholders in Wall Street to applaud you, which will cause the stock price to rise, which will get you a big juicy bonus worth millions and an invitation out to lunch with the president. Just think Enron. But there are others. Number 30. There is a huge difference between the business that grows and requires lots of capital to do so, and the business that grows and doesn't require capital. This is the big secret in Warren's buy and hold forever strategy. If you buy and hold a business that requires lots of capital to grow, your stock is never going to grow in value. The reason is the constant drain of capital just to keep the business from sinking in the wake of competition. If you have to spend billions redesigning your product mix every 5 years, those are billions that can't be spent expanding operations or buying new businesses or buying back stock. But a business that can grow without new infusions of capital and afford to spend its excess cash doing those things, all of it will increase the company's per share earnings, which will in turn cause the company's stock price to increase. This is why Warren prefers companies like Wrigley's and Coca-Cola as opposed to GM or Intel. Companies like Wrigley's and Coca-Cola never have to spend billions redesigning their product or retooling their manufacturing plants, which leaves them plenty of money to spend on such fun things as buying back their own stock. GM and Intel, on the other hand, have to constantly spend billions on new designs and retooling. If either one stopped spending billions on new designs or retooling, it would be put out of business by its competition. If a business needs lots of capital to grow, it will never make you rich. And if it doesn't need lots of capital to grow, it won't ever leave you poor. Number 31. In a difficult business, no sooner is one problem solved than another surfaces. Never is there just one cockroach in the kitchen. A business with poor economics is a slow boat to nowhere and makes a lousy long-term investment. The intensely competitive nature of the business means that it will suffer slim margins on sales and have a constant need to upgrade the plant to stay competitive. If its products have to constantly change to stay competitive, then there is the added problem in financing research and development. For example, if a company that manufactures autos decides to change its line of products, it is going to have to spend billions retooling. One wrong guess and it might just bankrupt the entire operation. All of these things drain capital that could be spent to increase earnings, such as expanding operations, buying new businesses, or repurchasing stock. These constant crises of poor margins and poor earnings mean a constant battle with costs. And if you add in competition for overseas labor, you may find yourself in a business that is no longer operationally viable in its present form. In the game of long-term investing, these are the kinds of businesses that you want to stay away from. Warren avoids them like the plague, even if the stock market isn't giving them away. Number 32. You can always use sales by going down market, but it's hard to go back up market. Certain products on a piece of your mind. They're the brand name products that you think of when you have a particular need. Kleenex, Tampax, Windex, Snickers, Wrigley's, Disney, and Coke are all brands that own a piece of the consumer's mind. Along with owning a piece of the consumer's mind goes a set of consumer expectations regarding that product. And because these products all meet those expectations, their manufacturers can charge a higher price for fulfilling the consumer's needs. Manufacturers will spend millions on getting their products to this vaunted status. However, if a manufacturer, in the name of increasing profits, decreases the quality of its products, it can run a huge risk of losing its ownership of the consumer's mind. We've all seen this happen. A quality product we love to use, but then the manufacturer cheapens it and we stop using it. Once this happens, it is hard for the manufacturer to go back because the bad experience with the product now owns a piece of the consumer's mind. Number 33. When a chief executive officer is encouraged by his advisors to make deals, he responds much as would a teenage boy who is encouraged by his father to have a normal sex life. It's not a push he needs. As Blaise Pascal, an influential French mathematician and philosopher, once said, all man's miseries derive from not being able to sit quietly in a room alone. CEOs can't sit quietly. They are predisposed to make deals, which are made easy to do by Wall Street, and create the illusion that they are doing something to justify their incredibly high salaries. Besides, it is often easier to buy a new set of problems than it is to try to fix an old set. One solution to this rating appetite to grow through acquisitions is to only buy companies that have some kind of durable competitive advantage. These companies have great underlying economics working for them, as evidenced by high returns on equity and strong and consistent earnings. The other kinds of companies here labeled commodity-type businesses, which are evidenced by low returns on equity and erratic earnings. Since most of the companies in the world fall into the commodity type, it is easy for Warren to find some rest. But when a company shows up with a durable competitive advantage, he jumps on it 10 minutes after he sees the deal. Warren knows what he wants before he wants it. Number 34. You don't have to make money back the same way you lost it. Beginning investors sometimes think that the only game in town is the stock they just lost money on, so they keep playing it, as if it's a game in a casino, hoping that their luck will change. But with stocks, unlike casino games of chance, their risk varies dramatically from one stock to another, all of it based largely on two factors: the quality of the company and the price you pay for its shares in relation to that quality. The higher the quality, the lower the risk, and the lower the price in relation to the quality of the business, the lower the risk. Most of the time, high quality comes with a high price, which is not that good a deal. But occasionally the stock market does something streaky and you get high quality selling at a low price. This is where the easy money is made. What you want to stay away from is low quality businesses selling at a high price, because that is where fortunes are lost. Low quality at a high price in relation to the quality of the business means stay away. And high quality and a low price in relation to the quality of the business means come to play. But every single stock is in a game with new odds, which change as the price of the stock changes. So wait till you find one where the odds are so much in your favor that you have a margin of safety. Then bet big. The funny thing about the stock market is that, unlike a casino, it occasionally serves up a sure thing. Warren is all about the sure thing. Number 35. I look for businesses in which I think I can predict what they're going to look like in 10 to 15 years' time. Take Wrigley's chewing gum. I don't think the internet is going to change how people chew gum. Consistent products equal consistent earnings. If the product doesn't have to change, you can reap all the benefits without having to spend money on research and development, nor do you have to fall victim to the ups and downs of fashion. Think of beer, soda pop, and candy. Budweiser has been making the same brew for over 100 years. Coke has been selling the same magical caramel-colored sugar water for over 100 years, and Wrigley has been making the same chewing gum for, you guessed it, over 100 years. Catching the trend here? Do you think you can predict what these companies will probably be selling in 15 years? If you can, then you might just be the next Warren Buffett. Warren's mentors. Number 36. Someone is sitting in the shade today because someone planted a tree a long time ago. If not for the hard work of Warren's mentor Benjamin Graham in developing the concept of value investing, Warren might never have gotten out from behind the counter at his grandfather's grocery store. For it is easy to become brilliant at what you do when you stand on the shoulders of a giant. The trick is picking the right giant. In Warren's case, he chose Graham, a man known as the Dean of Wall Street. Graham developed a concept of value investing and taught a course on it at Columbia University in New York City. Warren took Graham's course, and in the words of his classmate Bill Irwin, sparks were flying between the two. After Columbia, Warren went to work at Graham's Wall Street investment firm, and the rest of the story is the stuff of which financial legends are made. Number 37. With enough inside information and $1 million, you can go broke in a year. Face it, by the time inside information gets to you, everyone else has heard it and traded on it. Besides, trading on inside information is against the law. Warren has often said that one of the advantages to living in Omaha is that no one's around to whisper inside scoops in his ear over lunch. Often, unscrupulous types start rumors so that they can drive up the price of shares so that they can dump them in a lapse of gullible investors. Famed 1920s investment great Bernard Baruch was famous for selling out a stock position as soon as someone gave him a hot tip on it. Baruch, by the way, died a very, very rich man. Number 38. Read Ben Graham and Phil Fisher. Read annual reports, but don't do equations with Greek letters in them. Ben Graham taught that you should only buy a stock when it is selling at a low price in relationship to its long-term value. The low price will give you a margin of safety against calamity. Phil Fisher said that you need to buy a high-quality company and hold it for a long, long time and let the retained earnings build up the value. Warren took Ben's buy at a low price to get a margin of safety and narrated to Phil's buy the highest quality company and hold it forever, and ended up with buy high-quality companies at low prices in relation to their value and then hold them for a long, long time. This is one of those equations where the sum is greater than its parts. Warren ended up making far more money than either Ben or Phil, who were the master investors of their day. As far as the equations with Greek letters in them are concerned, they are for the Wall Street types who didn't get around to reading Ben and Phil. Number 39. I am a better investor because I am a businessman, and a better businessman because I am an investor. A smart businessman knows a good business from a bad one, and a smart investor knows when a business is being sold cheap or is overpriced. So to be great at investing, you need to be like the businessman and know the good business from a bad one. And when you go to buy a business, you need to be like a smart investor and know whether it is selling cheap or it is overpriced. Combine the two and you can make $1 billion. It's that easy. And it's that hard. In Warren's early days, he was only concerned with the historical financials of the company. He didn't really care about the products it produced. His mentor Graham believed the numbers reflected everything there was to know. He didn't separate a commodity-type business such as textiles, which has poor long-term economics, with a consumer monopoly business such as Coke, which has great long-term economics. But as Warren became active in running a struggling commodity-type business, he soon realized that it was the consumer monopoly-type companies that had the competitive advantage and were producing the superior results. Graham would buy anything as long as it was cheap. Warren will only buy a consumer monopoly-type company that has a competitive advantage, and he doesn't have to wait for it to be selling cheap. The fair price is all he needs if he holds onto it long enough to make his billions. Number 40. If principles become dated, they're no longer principles. Warren woke up one morning and discovered that the investment principles he had learned from his teacher Graham were no longer useful. Graham had advocated buying cheap companies regardless of the underlying economics of the business. This strategy worked well in the 40s and 50s, but it lost its effectiveness as a larger group of investors began to practice this kind of investing. It became harder and harder to find the golden eggs. Instead of staying the course, Warren jumped ship and adopted a philosophy of investing in exceptional companies that had a durable competitive advantage, as long as they were selling at reasonable prices. Then he would let the rising waters of time and earnings lift the price of the stock. This new philosophy lifted him from being rich to being super rich. An excellent example of this was his investment in Coca-Cola, for which he paid approximately 20 times earnings. The old Warren would never have made this investment because the Grahamian valuation techniques would have deemed it way too pricey. But for the new Warren, it was a more than fair price that paid off for him in the billions. Sometimes it is a good thing if a leopard can change his spots. Number 41. You pay a very high price in the stock market for a cheery consensus. If everyone agrees with you that a particular stock is the next Microsoft, you're going to have to pay a steep price, which leaves little upside and lots of downside. What you want is to find a stock that no one is looking at, or that is out of favor with the big investment funds and is selling at a low price relative to its long-term economic value. Many that have risen shall fall, and many that have fallen shall rise again. This was the battle cry of Warren's mentor Benjamin Graham. We're interested in the rise again part. We do not want to be paying sky-high prices for stocks that are just waiting to fall. We want to be paying bargain prices for stocks that are waiting to rise. Education. Number 42. If calculus or algebra were required to be a great investor, I'd have to go back to delivering newspapers. According to Warren, the math skills you need to be a great investor are addition, subtraction, multiplication, division, and the ability to rapidly calculate percentages and probability. Anything more, as the French would say, is a waste. Anything less, and you can't play the game. Number 43. You have to think for yourselves. It always amazes me how high IQ people mindlessly imitate. I never get good ideas talking to other people. Many high IQ types think that the way to get rich is to imitate others. This is in part due to an education system that rewards imitating the professor. On Wall Street, the dominant investment strategy is based on imitating what the herd is doing. It is easier to sell you something that is popular as opposed to something that is unpopular. Warren isn't trying to sell anyone investments. He's just trying to get rich off investments. This is done not by following the herd, but by identifying stocks that Wall Street doesn't want today, but will be dying for tomorrow. As for those who follow the herd, well, they usually spend a lot of time scraping their shoes. Number 44. The smarter the journalists are, the better off society is. We get our information for processing investment ideas from the media, which means we are wholly dependent on journalists for accuracy and proper analysis of what is going on. Do you want dumb people keeping us informed? Or do you want intelligent people doing the job? Warren has always subscribed to the idea that the better the teacher, the smarter the student body. Thus, the smarter the journalists, the smarter the society. The only people who don't want a smarter society are liars, thieves, and politicians who are trying to hide something. Number 45. You want to learn from experience, but you want to learn from other people's experience when you can. Experience is the best teacher, but it can be expensive if you are learning from your own mistakes. It is better to learn from the mistakes of others. This is why Warren has made it part of his educational diet to study and dissect the business and investing mistakes of others. He wants to learn where they went wrong so he doesn't go there. This is a completely opposite strategy from that of most business schools, which study only success stories. In business and in investing, more people end up in the gutter than on Easy Street. You need to study not only what to do, but what not to do. The workplace. Number 46. It's hard to teach a young dog new tricks. Bob has found that the business acumen that comes with age is next to impossible to teach to younger managers. The old birds have got it wired and know how to make a buck. Warren is in his 70s. His partner Charlie Munger is in his 80s. Mrs. B ran the Nebraska Furniture Mart at over 100, and many of the managers at Berkshire Hathaway, Warren's holding company, have stayed on well into their 70s. Warren has no mandatory retirement age at Berkshire. In Warren's world, 65 is just getting started. Age and experience can be far greater virtues than youth and enthusiasm when it comes to making money the old-fashioned way. Number 47. In looking for someone to hire, you look for three qualities: integrity, intelligence, and energy. But the most important is integrity, because if they don't have that, the other two qualities, intelligence and energy, are going to kill you. When you hire someone to run your business, you are entrusting him or her with the piggy bank. If these people are smart and hard-working, they're going to make you a lot of money. But if they aren't honest, they will find lots of clever ways to make all your money theirs. So if you have to hire people who aren't honest, make sure they're not hard-working and are dumb as bricks. That way, all they will be able to steal are the bricks. Integrity is the key ingredient to Warren's management philosophy. When he bought the Nebraska Furniture Mart from Mrs. B, he surprised her and the rest of the Mart's management by not requesting an audit of her books. He simply asked her what it was worth, and she told him. And the next day, he brought her a check for $40 million. When Mrs. B asked him about it later, he replied that he trusted her far more than he trusted his accountants. Also, Warren's management style has always been to afford his managers tremendous operational autonomy. They are free to run the businesses as if they are the owners. He couldn't give his managers this much freedom if they lacked integrity. Number 48. Can you really explain to a fish what it is like to walk on land? One day on land is worth 1,000 years talking about it, and one day running a business has exactly the same kind of value. As they say in the military, it's all fun and games until someone starts shooting back. The same applies to the business world. Dealing with real manufacturing problems and getting and keeping real customers is what separates the academics from the managerial real world. At the Berkshire-owned Nebraska Furniture Mart in Omaha, company founder and top manager Mrs. B rode to business victory after victory, decade upon decade, with the frontline troops at the nod. Age and experience before youth and enthusiasm has become Warren's battle cry that makes Berkshire's cash register ring and ring and ring. Number 49. It's only when the tide goes out that you learn than swimming naked. Creative accounting has let more than a few of Wall Street's darlings rise to the top. But if the real money doesn't show up at some point, the enthusiasm and illusions fall away, and all that is left is an empty bank account and a bankruptcy filing. The tide went down on Enron, and we all saw that the emperor had no clothes. The problem is finding out who is swimming naked before the tide goes out. Number 50. When ideas fail, nerds come in very handy. This is Warren quoting Goethe, and what he means by this is that when your great idea blows apart and you lose the business, you will use words to conjure a great excuse so you won't look as if you're incompetent. In a world of CEOs, there is a never-ending quest for good excuses to soothe irate shareholders' anger over management's poor decisions. By not taking the blame, they are essentially saying that the buck doesn't stop here. If it doesn't stop at the CEO, then he must not really be our leader, right? If he isn't our leader, then why don't we go out and get ourselves someone who can lead to run our business? It is our business, isn't it? We are the owners, right? Warren has never forgotten that Berkshire's shareholders own the business that he runs. And his language is always forthcoming, not only about the good news, but also the bad. Number 51. The really good business manager doesn't wake up in the morning and say, "This is the day that I'm going to cut costs," any more than he wakes up and decides to practice breathing. The time to get your vaccinations is not the day after you contract a disease. In the business world, active managing is done reactively. Warren believes in proactive management, fixing the potential problem before it becomes a problem. You keep costs low from the start, which keeps our powder dry for an attack by your competitors, and creates more profits when things are good. Warren staffs Berkshire's home office with a mean office machine of 7T. Here's a man who practices what he preaches. If you read that a company is instigating a cost-cutting program, then you know that management has been slacking in keeping costs low from the start. What do you think of a company with management that does not have a grip on costs? Do you think they're going to make their shareholders a lot of money? Number 52. Wouldn't it be great if we could buy loads for $1 million? But the only way to be loved is to be lovable. You always get back on and you give away. If you don't give any, you won't get any. There's nobody I know who commands the love of others who doesn't feel like a success. And I can't imagine people who I've loved feel very successful. Love is important in Warren's personal life, and he's incorporated it into his business and management philosophy. He only hires people who love what they're doing, because if you love what you're doing, you will treat others well, so that they will in turn also love what they do. He never degrades his managers when they make mistakes. Rather, he encourages them not to dwell on mistakes and to get on with business. His love and respect for his managers is so strong that he trusts them completely with the business that they run. He gives them complete control over them, which promotes a strong sense of responsibility. Warren talks endlessly about how proud he is of his management teams, and never hesitates to sing their praises in public. This is how he is able to attract the best and the brightest managers in the world. Love and respect really do beget love and respect. It's the first step on the road to being a success in life. Number 53. We enjoy the process far more than the proceeds, though I have learned to live with those also. People who are passionate about their jobs will come to rule their trade or profession because they love the process more than the money. The funny thing about passion is that money usually follows it. People who love money more than their work spend their lives working in misery, and usually end up earning much less than if they had followed their heart in the first place. The greatest thing about being passionate about your work is that it really isn't a job, it's fun. Warren has always said that he loves what he does so much that he would pay to have his job. But he doesn't have to, because he makes a ton of money doing what he loves. Number 54. If you hit a hole in one every hole, he wouldn't play golf for very long. A job with challenges keeps things interesting, creates high self-esteem, promotes creativity, and attracts the highest quality people. A job without challenges is boring, creates low self-esteem, and attracts the least motivated people. However, for challenges to be present, there also has to be risk. In the world of business, as challenges arise, decisions have to be made, and inevitably mistakes will happen. It is the nature of making decisions, and it is also what makes it also interesting. Warren has learned that if he wants to attract the best and brightest managers, the ones who are self-motivated and aggressive in taking on challenges, then he must give them a work environment that will allow them to make the mistakes that come along with the successes. Number 55. There comes a time when you want to start doing what you want. Take a job that you love. you will jump out of bed in the morning. I think you are out of your mind if you keep taking jobs that you don't like because you think it will look good on your resume. Isn't that a little like saving up sex for your old age? Spending a life getting up and going to a job that you hate with people that you don't respect leads to frustration and discontent, which you bring on with you from work and share with your family, which makes them unhappy as well. This, of course, makes for a lovely life for everyone you love, including yourself. It is much better to find a job that you love than going to work puts a smile on your face, which you can take on with you at the end of the day to share with your loved ones. And if you're worried about the money, keep in mind that the people who love what they are doing are the ones who rise to the top of their fields and end up making the most money. Be it the poor Russian immigrant who couldn't read but loved to sell furniture, or the needy son of a grocery clerk who had a thing for numbers and stocks. Do what you love and the money will come. It works for them, and it will work for you. Number 56. A friend of mine spent 20 years looking for the perfect woman. Unfortunately, when he found her, he discovered that she was looking for the perfect man. What Warren's friend failed to realize is that selling someone on what you have is different from buying what someone else has. He was sold on her goods, but she wasn't sold on his. In life and in business, you have to sell the other person on who you are and what you have for them to buy. Warren had to sell himself to his original investors, and he still has to sell himself to the privately held family businesses that Berkshire wants to buy. People who have spent their lives building a business aren't interested in selling their baby to just anybody. Warren sells them on the idea that he will give those businesses a good home. In our daily lives, we have to sell ourselves to our employers and to our customers. Business relationships are just like personal relationships. They are best started by showing an interest in the other person and in finding out what that person's needs are. Because ultimately, we are selling to those needs. He or she who forgets that will spend a lot of time sitting alone at the bar. Analysts, advisors, brokers, follies to avoid. Number 57. Never ask a barber if you need a haircut. Ask an advisor if there is a problem, and you will find a problem, even if there isn't one. Warren found this to be true of investment bankers, management advisors, lawyers, auto mechanics, lawn care consultants, and the like. People who are paid to fix problems will always find problems, because if there isn't a problem, there is nothing to fix. Number 58. Forecasts usually tell us more of the forecaster than of the forecast. What most people forget is that most forecasters have an agenda that reflects the interests of the people who are paying their salary. If they are being paid to be pessimistic, they will be pessimistic. If optimism is needed, then it is optimism you will get. People are what they are being paid to be, no more, no less. Forecasters don't have a crystal ball that they can see into the future with, but they do have mortgages that need servicing and children that need to go to college. Wall Street likes to see a lot of trading activity, and that means it needs reasons to make a lot of changes to your investment portfolio. If the forecaster says interest rates are going up, you sell your stocks. If he says rates are going down, you buy stocks. They do the same thing with individual stocks. Predict lower earnings this quarter and you're selling out. Predict higher earnings this quarter and you are buying in. Wall Street makes its money off you moving around your money from one investment to another, so naturally, Wall Street forecasters, also known as analysts, are going to find lots of reasons for you to do just that, move from one investment to another. The problem is that all this activity has nothing to do with making you rich. Number 59. The public opinion goal is no substitute for thought. There's a great deal of comfort when you invest with the crowd. Everyone agrees with you. However, when you invest with the crowd, you have to worry about when the crowd will leave the party, because just like a nice fool, no one stays popular forever. There usually isn't much upside potential left in a stock after it becomes really popular, which means you took on a lot of risk for a shot at a low rate of return. If you are a thinking investor like Warren, you look for stocks that are going through an unpopular phase, because that is where you are going to find tomorrow's Mr. Popular selling at a discount price, which equates to a low risk of losing your money and great potential for a high rate of return. Number 60. The business schools reward difficult, complex behavior right of simple behavior, but simple behavior is not active. The evil English philosopher and Franciscan monk William of Ockham, circa 1285 to 1349, affectionately known in some scientific circles as Billy Ockham, puts forth the idea that the simplest explanation is usually the best explanation. The problem with this idea is that priests of any profession need complexity to keep the laity from performing mere priestly magic. If you understood the investment process, there would be no need for investment analysts and advisors. Nor would we need mutual funds or any of the other priests of the profession. Just finding a great business and buying it at a great price, and then holding it for 20 years. It's not that hard to learn and profit from when all the so-called priests of Wall Street are preaching short-term investment strategies, which in truth are completely geared to making the advisor, and not the advisee, rich. Number 61. There seems to be some perverse human characteristic that likes to make easy things difficult. Every profession is ultimately a conspiracy against validity. Only when something is made difficult to understand is there a need for experts, who can charge high fees for having figured it all out. The greater the complexity, the greater the need for an expert to help guide you through the complexity. Wall Street is in the business of selling its expertise and picking stocks for you to invest in. And because of this, brokers have a vested interest in presenting the investment game as being so complicated that it is beyond understanding for anyone but the most savvy of pros. Their scheme is simple. They're going to get rich off making you rich, and they keep you coming back because they have convinced you that the investment game is too complicated to figure out. But no one ever asks why, if they are so smart, do they need other people's money to get rich? Maybe they need your money because the game doesn't have anything to do with you making money off investments. Rather, they make their money by the commissions they charge you to move you in and out of investments. As Woody Allen once said, the stockbroker is someone who invests other people's money until it's all gone. Number 62. Recommending something to be held for 30 years is a level of self-sacrifice you'll rarely see in a monastery, let alone a brokerage house. Your stockbroker would starve to death before he would adopt Warren's strategy of buy and hold. It's not that brokers don't believe it will create wealth. It is just that it don't create any wealth for your broker. They make all their money on the commissions they receive by getting you into and out of stocks. The more you get in and out, the more money they make. And they always seem to have a reason to get you into something and out of something else. If your broker has more than one great idea a year, the odds are good he is delusional. If your broker wants to sell you out of a position that he put you into last month because the market conditions have changed, he might be little more than delusional. He might just be dishonest. Why not to diversify? Number 63. I can't be involved in 50 or 75 things. That's a Noah's Ark way of investing. You end up with a zoo that way. I like to put meaningful amounts of money in a few things. If you were to invest in 50 different stocks, then your attention and ability to keep track of the business economics of each and every one would be severely limited. You would indeed end up with a zoo, in which none of the animals got the attention it needed. It's like being a juggler with too many balls in the air. You don't just drop one, you end up dropping them all. Warren puts meaningful amounts of money into his investments because great investment ideas are often few and far between. He says that you only have to make a few right decisions to end up rich, and that if you're getting more than one brilliant investment idea a year, you are probably deluding yourself. Number 64. Diversification is a protection against ignorance. It makes very little sense for those who know what they're doing. If you don't understand what you are doing, you should probably diversify your investments with the hope that not all your eggs will go bad. If your investment advisor recommends broad diversification, he is really telling you that he doesn't know what he is doing, and he wants to protect you from his ignorance. Warren knows what he is doing, so he prefers to concentrate his investments on a few well-chosen eggs, and then he watches them like a hawk. Number 65. Wall Street makes its money on activity. You make your money on inactivity. The name of the game on Wall Street is to get control of your assets and then milk you for commissions. Brokers have 100 ways of doing this. They will have you buying and selling on interest rate news, bad quarter or good quarter earnings reports, and every analyst's recommendation that comes across their desk. They will even have you trading on the outcome of presidential elections. They make money off activity, any activity, and as long as you are willing to go for it, they are happy to take your money. For you to make money in the stock market, you need to buy a great company at a fair price or below, and hold it for a long time, thereby letting the company's retained earnings build up its underlying value. This is how everyone from Bill Gates to Warren Buffett got super rich. Gates did it with just one stock, and Warren did it on a half dozen. It really does work. Just look at who are the first and second richest men in the world. If you still don't believe it, go ask the 100 or so people in Omaha who 30 years ago put all their money into just one company, Berkshire Hathaway, and who are now each worth over $50 million. Number 66. Why not invest your assets in the companies you really like? As Mae West said, too much of a good thing can be wonderful. Warren is famous for highly concentrated stock positions, and he is willing to keep adding to those positions as long as the economics of the business are there and the price is right. Sometimes he will build a large position over a number of years, as he did with Coca-Cola. This is contrary to the strategy of diversifying risk, also known as not putting all your eggs in one basket. Warren has always believed that if you diversify just for the sake of diversity, you will end up with a menagerie for a portfolio. never really understanding any of the businesses in which your money is invested. He would rather think long and hard about what basket he is putting his money into. Then once he puts it in, he'll watch that basket like a hawk. Number 67. Why diversification is only required when investors do not understand what they are doing. If some investment advisors are trying to sell you on the idea of diversifying your stock portfolio, it is because they don't know what they are doing when it comes to investments, and they want to check you from their ignorance. And if you don't know what you are doing, diversification is a wise course, in that it will offer you a modicum of protection against losing everything, and the potential for average growth over the long run. However, it is never going to make you rich, because the strategy is based on the winners and the losers canceling each other out. It will, however, never leave you poor. Number 68. You only have to do a very few things right in your life, so long as you don't do too many things wrong. The principles of life and investing often parallel each other. To succeed in life, you will only have to get a few things right. The only way that you can screw it up is to make a series of bad decisions. That doesn't mean that you can't make mistakes. You just can't make too many big ones. The same goes for investing. Make a few right investments and you can make a fortune. But every time you make an investment decision, there is a chance that you will get it wrong. Make a few bad ones, and you will eventually wipe out the gains from the few good ones you made. Warren decided early in his investing career that it would be impossible for him to make hundreds of right investment decisions, so he decided that he would invest only in the businesses that he was absolutely sure of, and then bet heavily on them. He owes 90% of his wealth to just 10 of these. Sometimes what you don't do is just as important as what you do. Discipline, prudence, and patience. Number 69. If you let yourself be undisciplined on the small things, you will probably be undisciplined on the large things as well. Warren has found that people often make exceptions to a disciplined investment strategy when they are making small investments, and that this behavior often leads to an unraveling of a disciplined approach. Discipline is the key to success in the investment game, just as it is the key to success in much of life. Warren so believed in a disciplined approach that he has turned down a $2 golf bet because the odds were against him. He freely admits that on the golf course the odds are usually against him. In Warren's world, little things really do matter. Number 70. There is nothing like writing to force you to think and get your thoughts straight. If you can't write about it, you haven't really thought about it. This is why every year, Warren sits down and writes a long letter to his shareholders explaining the past year's events. This exercise has helped him immensely to fine-tune his thoughts on how to make billions. Writing about something makes you think about it, and thinking about where to invest your money is a good thing, which is why writing about it is even a better thing. Warren usually begins writing his annual report right after the new year in his winter home near the water in Laguna Beach, right down the street from Benjamin Graham's old place. He writes it in longhand, pen and paper, then ships it out to his friend Carol Lunas, editor-at-large of Fortune magazine. Even a genius needs the helpful hand of an editor. Number 7. This was number 70. I'm done today. I hope you enjoyed the book The Tao of Warren Buffett. It presented a lot of valuable lessons that we can use in our day-to-day life, business life. I hope you learned some valuable lessons in the name of the Father, and the Son, and the Holy Spirit, now whenever it enter ages of ages. Amen.
In the name of Jesus, thy we shall be.